Hey guys, welcome back to another episode of Boss Economics World, where we dissect global financial issues, cut through the fluff, and tell you how things really are. Today, we'll be taking a hot look into the Philippine stock market. Yeah, you heard me right, the place where hopes seem to be building momentum yet reality checks keep pulling the brakes. Today's discussion is one that has been grabbing headlines across the Asia-Pacific region and globally. After all, it's not every day you see a stock index hitting its lowest point in Asia, only for analysts to turn around and claim that a whopping 26% gain is right around the corner. But wait, before getting too excited, we need to ask some important questions. Why did the market tumble in the first place, and if it's really set for a rebound, what does that mean for the wider economy? So let's dive into it. You're probably already aware that the Philippine Stock Exchange Index, PSEI, posted the steepest drop in Asia after the 2016 US election, losing roughly 10% of its value against the Asia-Pacific Regional Index, but you might not know that this wasn't simply an isolated event. While it's easy to blame the fallout on Donald Trump's win and the uncertainty of his protectionist policies, which yes, did have their role, the truth is, the Philippine economy faces issues far more deeply entrenched than just external shocks. Here's the kicker: macroeconomic vulnerabilities, a struggling currency, political uncertainty, and over-reliance on specific sectors make recovery anything but straightforward. So is this stock market downturn really what we call a buying opportunity, as optimistic analysts suggest, or is it a reflection of systemic weaknesses that will continue to plague the economy? Let's break it all down from micro to macro and paint a holistic picture for all of you, both novices and pros alike. Let's tackle the most obvious first, the impact from Donald Trump's election win. Sure, there was a global recalibration surrounding economic expectations in emerging markets like the Philippines, particularly over Trump's protectionist rhetoric. Since Trump's election, the strong US dollar has been one of the most significant factors weighing on the Philippine markets. Global investors rebalanced their portfolios in favor of safe haven assets like US stocks and treasury bonds, leaving emerging market stocks sucking wind. This of course, hit the Philippines hard. On top of that, the rising interest rates during Trump's presidency made it more expensive for countries like the Philippines, which rely heavily on imports supported by external financing, to service their debt and pay for key items such as oil. So yeah, the strong dollar, rising US interest rates, and the withdrawal of foreign funds dealt serious blows, but were these the Philippines' underlying issues or symptoms of a much bigger problem? Here's where things start getting ugly. The Philippine economy has long been heavily dependent on imports, especially for basic commodities such as fuel, raw materials, and equipment critical to its industries. Combine that import dependency with a volatile peso, particularly in times of global uncertainty, and you have a recipe for disaster. Each time the peso weakens, every dollar of debt becomes more expensive to repay, which further strains the national budget. To put this in perspective, we can cite data from the Philippines' budget deficit struggles. The fiscal deficit widened to PHP 1.67 trillion in 2024, equivalent to about 7.4% of GDP, a significant increase from the previous years. With a weak domestic currency, and recurring imports in critical sectors such as infrastructure and energy being priced in dollars, maintaining trade balances becomes not just difficult but next to impossible. Is the market's current decline only about dollar strength then? Absolutely not. There have been glaring structural weaknesses in the Philippine economy for quite some time. This brings us to the next point. The Philippines doesn't have the export prowess that some of its Southeast Asian neighbors like Vietnam, Thailand, or Malaysia boast. Southeast Asian countries have grown by capitalizing on the export of high-value manufactured goods or raw commodities. The Philippines, on the other hand, heavily depends on remittances from overseas Filipino workers, OFWs, and business process outsourcing, BPO, rather than a diversified base of goods exports. Now, remittances are a major driver of consumption in the local economy, no question about it. The country received more than $36 billion in remittances in 2023, which contributed a substantial 9.3% to GDP. And yes, BPO sectors have been on an upward climb, contributing roughly $32 billion annually to the economy. But are remittances and BPO enough to keep a national economy thriving? Well, no. BPO and remittance-driven growth isn't sustainable in the long run, especially when viewed against the volatility brought about by global economic shifts. In a world where global trade is becoming more competitive, the Philippines is facing a trade conundrum. The export of physical goods, particularly technology-intensive exports, is relatively weak compared to regional peers, rendering it more vulnerable to adverse global conditions. This means that without the benefit of large export earnings, the Philippines remains susceptible to foreign exchange volatility. So any strength in the stock markets may simply mask inherent weaknesses in the macroeconomic fabric. Alright, now back to the main news hooks around this commentary. Everyone's hoping for a surge in corporate performances to bring the market out of this funk. Analysts like Sasayan from Maybank Kim Ang are predicting a 26% jump in equity prices, and key banks like Rizal Commercial Banking Corp and Morgan Stanley are all singing a similar, bullish tune. Citibank says fourth-quarter earnings in the Philippines could show some of the strongest surprises across Asia. But here's my beef with that: corporate earnings in the short term rarely reflect the long-term systemic issues underlying the economy. Sure, we can expect some robust financial returns in particular sectors. Let's not forget the land grab opportunities in Manila's property market or perhaps consumer retail gearing up before the midterm elections. However, just like 2023's record earnings were fueled mostly by recoveries post-pandemic, 2024's rush was artificially stimulated by pre-election government spending. Once those elections dry up, and public infrastructure spending peters out, will earnings momentum truly hold? More fundamentally, we have to consider how earnings growth correlates with productivity growth. A recent Oxford economics report showed that Philippine productivity has been lagging behind Southeast Asian peers for years. Real productivity adjustments are slow and require investment into education, infrastructure, supply chains, technology, and all the things corporate profits alone can't sustain. In the long run, betting heavily on a stock market revival based on an earnings season mirage is risky. Don't get us wrong here, opportunities could abound for smart investors willing to absorb structural risks, but the broader systemic issues suggest a choppier road ahead. Another huge elephant in the room is the rising level of debt taken on by the Philippine government. As of mid-2024, the national debt soared to PHP 14.35 trillion, $257 billion, equivalent to about 61% of GDP, well above its historical average and concerning for a country that is still classified as an emerging market economy. Additionally, if the central bank is lowering interest rates to help the market rebound, as Michael Ricafort suggested, we should realize that loose monetary policy isn't a magic panacea. Artificially low interest rates can also distort risk-taking, lead to asset bubbles. Watch out for real estate here, as the speculative building boom in Metro Manila has been concerning, and do nothing to tackle long-term structural issues like low productivity. Moreover, domestic inflation remains too hot for the central bank to continue cutting rates forever. In 2024, inflation reached a historic 7.9%, driven by higher food and fuel prices. Simply hoping for rate cuts to jumpstart the economy might bring side effects like currency depreciation and further import price rises, deepening the country's inflation woes. And oh, one more thing to add, the budget deficit is ugly. The administration has been spending more money than it collects, particularly in the lead-up to these elections, prompting borrowing to fill those gaps. The more they borrow, the more they owe. You don't have to be a genius to see where this is going. So, looking forward, are we cherry-picking some positive corporate earnings outlook and projecting that onto the entire economy's recovery potential? Probably. While it's true that short-term market dips can create buying opportunities, it's equally true to expect that underlying economic weaknesses, an over-reliance on remittances, a lack of diversified exports, import dependency, a growing debt burden, and high inflation, will not magically vanish with a few strong quarterly earnings reports. Ladies and gentlemen, I'm not here to tell you that the Philippine stock market is hopelessly doomed or destined for paradise. The truth, however, is that expecting the market to climb 20% to 26% in 2025 or for the benchmark index to hit 8,000 ignores the very real pressures dragging this economy down. Could the market bounce back? Absolutely. But do the systemic risks persist? You bet. This isn't just a short-term reaction to the US elections or Trump's strong dollar policy back in the day. The Philippines needs deep, long-term adjustments to stay afloat in the continuously evolving Asia-Pacific ecosystem and global markets more broadly. Without stronger governance, better fiscal management, productivity investments, and trade reforms, we can cheer on the short-term gains for now, but those gains will come with significant long-term pain. Thanks for watching, folks. Don't forget to like and subscribe for more episodes where we pull apart the superficial narrative and tell you what's really going on. I'm your humble host, and until the next show, keep your eyes on the economy, stay sharp, and never stop questioning the news.